Hello, and welcome to part 3 of the production module. And today we'll be discussing business organizations. Now, this will be a fast one, mainly because we're going to just go through a short introduction to this. We're not going to go into a deep dive of the different business organizations that are available, mainly because that would fill in too much detail and you could easily make an entire module or even a whole year's worth of material based on just the different types of organizations. Now, the background for today is Amsterdam, which is the capital of the Netherlands, and this is important because this is where the largest company in the world, at least historically, um, is based. Okay, so it doesn't exist now, but it used to be based in the Netherlands. So, can anyone tell me what the largest company is as of the moment? Largest publicly traded company. So we're not talking about state-owned company. So we're talking about the largest company on earth right now. So if you guessed Apple, you're correct, but that was the largest company last year. This year, with Saudi Aramco, which is a oil company, being open for the public, that suddenly became the largest publicly traded company on earth at the current moment. However, Apple and even Saudi Aramco pales in comparison compared to the Dutch East India Company, which has a symbol VOC, as you can see over there. And as you can see, so the picture in the middle here with the Apple logo, Alphabet, Microsoft, Amazon. So those are all the market. So those are all the sizes of each company, and all of that taken together, that's equal to the Dutch East India Company. So you can see how large it was back in the day. Okay, and so basically, this is an example, and this is an example of a very early example of a corporation, which we'll be talking about in this module. So bear that in mind. There's bonus content later on about the limited liability company, which the VOC was, and we'll talk more about that later if you want to listen further on for the bonus material. But for now, let's get to the actual topic. So let's just have a recap from a previous discussion. So remember that we said that the primary goal of a business is to maximize profit for its owners, mainly the entrepreneurs. Now, this is a very classical theory, and we're going to stick by this for a bit, mainly because, again, this is just an introductory course in economics, and we're not going to go into nitty-gritty details about how not all businesses exist to primarily to maximize their profits. Some don't, and there are some businesses that exist like that, but we'll not go through too much of that today. All right, so just remember, maximize profits, and that's where we'll be going. So how many owners can a business have though? So let's have a look. Let's say something as simple as a cafe. How many owners can a coffee shop have? So if you think about pop-up coffee shops, for example, like this one over here, where basically you've got a pop-up coffee shop in the middle of the street. You can imagine that somebody who had a little bit of money, with a little bit of capital to start off with, could set up a coffee shop like that. So you could have one owner of a coffee shop, or you could partner up with somebody, say a friend or a group of friends, to build your own coffee shop. Let's say in case you don't have enough money for yourself to own a coffee shop, you partner up with somebody else. So an example of that actually, and one that's actually quite big, is UCC. So UCC is actually a partnership where there's two guys who partnered together to create UCC, and it's just grown massively over the past few years. Or you could have the public own the company through a corporation. And one important example of that is, of course, Starbucks, which is a publicly traded company. It was founded by Howard Schultz a few decades ago, but ever since then, I think it was either in the 90s or in the early 2000s where they became public, and then now it's anyone can own shares of Starbucks. So that's what we call a corporation. And we'll be talking about, and then we'll see these definitions. So here's some of the textbook definitions. So we've got three main types right now. So we got the sole proprietorship. So this is the smallest form, where you have one person who's owning the business. And then a more complicated form of that is partnership, where you buddy up with some friends or some acquaintances, and then you start a business together. So two or more. It doesn't have to be two; it could be more, as long as it's it's more than one, but it's not a huge kind of thing where there are many owners. And of course, you have corporations, where there's the ones that we're quite familiar with, where basically business are owned by stockholders who acquire a portion of the profit, which we call the dividend. All right, so these are the three main types of business organizations. We'll be talking about the fourth one later, but for now, these are the three most important ones. So let's have a look at corporations. So basically, incorporate literally means to take on bodily form. So if you know the word corporeal, right? So that means to have body. So basically, corporations are this amazing kind of structure where they're basically legal entities to themselves, which means they are separate from the persons managing the corporation. They are separate from the persons who actually own the corporation, which means they could be sued, they could enter agreements, and they can sue themselves. So basically, in the eyes of a law, they're just like another person. So they can go into all this legal stuff because they've taken on bodily form. It's a very weird concept if you actually think about it, but that's what corporations, in a nutshell, are, and that's what they are. So let's have a comparison of the different types of organizations, and it's very simple to categorize and differentiate between the three. So basically, from left to right, basically you get less and less control because you got more and more people who own the company. So for example, so a business that has only one person who owns it basically has total control. And if you got partnership, you need to share control. And if you got a corporation where it's publicly owned, basically you just relinquish control of the company, right? Now, however, on the flip side, on the other hand, though, the more owners you have, the more financial resources you're going to have, right? Because there's more available money that goes around. So if you own a coffee shop by yourself, you need to start that money off by yourself. But if you got a friend with you who's willing to partner up with you, then that means you'll have more resources to start off with. However, more owners means more legal agreements have to be made and more legal complications come in. So that's basically that's basically the thing that you've got to keep in mind. Now, there is another form that is discussed in your textbook, which is the cooperative. So there's a unique form of business organization wherein basically the owners are the employees themselves. So everyone has a share into the profits. So this is where the distinction in factors of production between labor and entrepreneurs are blurred. And so that's a cooperative. And basically other forms can exist too, but again, this is just a basic overview. And of course, it goes back to what we talk about profit maximization, where we have Milton Friedman talking about how the sole um, motivator of a business should be to maximize profit. And cooperatives are one of those things that actually fly against that, because the laborers are also the owners of the company, they have a stake in that, and they have a share in the business. They might not necessarily just want to maximize profits. They might actually want to maximize the longevity of the business, or they might want to maximize their own values and other things. So again, this is just a short, brief introduction just to show you the different sides of organizations. But there are more forms that exist too, and that's basically what it is. So with that, again, that was very short. Thank you for listening, and see you. Well, you'll hear from me in some other modules that you will have in the future. But if you want to stick around for the LLC discussion, please feel free to do so. So thank you again. All right, so thank you for those who've decided to stick around for this bonus material. So we begin with what Nicholas Murray Butler calls the greatest single discovery of the modern times. And basically this is what we'll be talking about. So this guy was a Nobel Prize winner for peace. And he was born around in the 1900s. And he was a scholar and academic. He was the president of Columbia University, I think. And so basically, he called this invention, what we are going to talk about, as the greatest single discovery of the modern times. And by the way, I am basing this bonus material on Tim Harford's The 50 Things That Made the Modern Economy. It's available in bookstores, but it's also available as a podcast on the BBC World Service in case you want to listen to it instead of reading it. It's available for free. So before I tell you what this is, we're going to have a story time first on the origins of this single greatest discovery. All right, so before we tell you what this greatest single discovery is, let me tell you about its origins. So the painting in the background is a painting by the Impressionist Claude Monet. It's called Impression Sunrise, and it's a very beautiful painting. And as you can see on the background of the slide, you can see that there are merchant ships at the background. All right, so this is basically what we're going to focus about when the age of merchants came in. Now, imagine yourself back in the day, and I don't mean back in the day of your grandparents or great-grandparents' time. I'm talking about hundreds and hundreds of years before, back to the medieval era, back to before Spain even had a clue of what the Philippines was. Right? We're talking about that far away. Now, imagine yourself you're a merchant. Okay, so what do merchants do? You buy from one place and then you sell it to another place, right? And sometimes, of course, you might not have that money to buy everything all at once. You might need to borrow money in order to buy your merchandise and sell it elsewhere. Now, because your business of trading was tied to you, any unpaid debt will eventually come back to you. What do I mean by that? For example, let's say you've decided to trade sugar. Yeah, something like that. You decide to trade sugar, and so you buy sugar from town A and you go to town B. But let's say, as it was common in those times, you got attacked by bandits or you got attacked by robbers, and then they stole off all your sugar. You remember that sugar, the money that you used to pay for that sugar wasn't yours. You loaned money for that. And now you can't make a profit because the sugar's gone and you still have that remaining debt. So what happens? What happens now is that your debtors, the people whom you loaned money from, they're going to ask that money straight from you, because remember, at this point in time, your business was tied to you. So any debt, any unpaid debt that were caused by your business failing or something happening to your business, you will have to pay for that. And so what do people do? Sometimes people had to sell their personal possessions. Sometimes people had to give up their assets, right, in order to pay off debt. And sometimes even, and this was in the Philippine system with the Alipin system, you had to go into slavery because that was the only way you could pay off your debt, right? And so this was a thing. There was a common thing back in the day. And it kind of makes sense. You start the business, you get the risk, and whatever happens, that's going to be your problem. Now, imagine commerce and trading opening up, right? So imagine now, move forward to yourself, the age of discovery, the age of colonization, when trading became a thing, when the new world started opening up, when Asia started opening up. What are you going to do? If you want to now become a merchant and there's trading goods and services, trading goods and spices across the world on ships, you can still do the whole let's get this old debt thing, and then once I make my trade, I pay you off. But in reality, you've got to remember how dangerous shipping was at that point in time in history, and you could lose everything in a storm. Just look at Frozen, right? Sorry. Yeah, so you could lose everything all at once. And a lot of people, and most people actually, just didn't want to take that risk. That risk is far too much. If your ship goes down, that's it, you're ruined for life. Because that's a huge shipment. You will never be able to repay that. Your children probably won't be even able to repay that. So there's a problem now where people are not willing to take enough risk. So what happened? The corporation was born, where basically people said, yes, the government chartered, you will only have limited liability. So this is what we call the Limited Liability Company, LLC, where you are not going to be any debts that happen because of your business is solely onto your business. And the way we do that is by we create a new entity that is not you. You may own the business, but you are not the same entity in the eyes of the law. So that means if ever something happens with your ships or something terrible happens to it, you will lose money, but you will not lose everything in your life. Okay, so what happens now is you kind of think of it as you got a separate account for your business and a separate account for your own savings. So that's how the LLC was born. And the Dutch East India Trading Company was one of these merchant ships trading. And you can see, as you can see from the beginning of this lecture, you could see how big it grew because of that limited liability. And most companies right now do operate that way. Okay, let's move on to the next slide. So, the LLC is a private company whose owners are legally responsible for its debts only to the extent of the amount of capital they invested. So that's exactly what I was. That's another way to say it uh, from what I've already said. And you see this all the time when you see companies, right? You have LTD, which means limited, LLC, which means limited liability company, PLC, which means partially limited company, and so much more. So you see all these abbreviations, and basically that means you can own part of this company, and if this company goes into debt, that's not going to be your problem. Is only to the extent of your investment. And this is basically how the modern stock market works, where basically you buy shares of a company. A share literally means a share, a piece of that company. And so that's how the modern stock market was born. Without LLCs, we would not have that concept. Because no one, for example, right, let's say you invest in Jollibee, no one in the right mind would want to invest in Jollibee. And if Jollibee gets into debt, you have to pay off Jollibee's debt. And imagine how big that would be, right? So you don't want to do that. And so, but with an LLC, we now have the ability to limit the amount of debt that the amount of debt that a person carries because of a business. So again, this allows us to actually create the modern world as we have it, because now we now have these corporations that are managed by managers. So yes, they are managed by managers. Um, who try to maximize profits for the shareholders, but the shareholders themselves aren't really liable for whatever happens to the company aside from whatever money that they invest in. Yes, you could invest a lot of money and you could lose a lot of money, but you can't lose everything unless you put everything in. All right, so that's the LLC, and this is a very powerful concept. And now, again, this is just a brief overview, so I'm not going to go any further into this, but it's actually quite an interesting thing. And the thing is, one thing I haven't said is that corporations limit your liability by making a separate entity for yourself. And even companies that are owned by a single person, businesses that are owned by a single person, can actually be incorporated. You can incorporate yourself so that you have a separate account for your corporation that is you, and then a separate account for your own personal thing. So that's actually something that's legal, totally legal in the law right now. I think it is. By the way, just a disclaimer, because I did say something legal. This is not law course, so anything I say here about the law may be wrong. So just pinch it with a pinch of salt, please. But yeah, but that's the point of the LLC is to limit basically the liability of its owners. However, though, as some of you might already know, there are lots of problems in the global reach of corporations nowadays. So here's a YouTube video about that tells us about one of those loopholes, where basically you've got a building with so many businesses in it, and basically it's just as a tax loophole kind of thing, so that they can pay lower taxes. It's quite interesting. It's about half as interesting. I know, ironic name, but it's quite an interesting video. And but that's the problem nowadays with corporations. Is the fact that because of globalization, that means corporations are not necessarily restricted by a certain government. So, for example, let's say in the Philippines, you can increase your penalties for not following certain standards, But what could corporations do? They could just threaten to move out, and that means that's a lot of tax money that doesn't go to the Philippines anymore. Let's say they decide, okay, we're going to move to Guatemala or something like that, and so that's actually creates a huge problem, because there are places in the world that are willing to accept, accept lower incomes as long as they've got company coming in them, because some is better than none. So this actually gives some sort of problem where corporations now have more power, and there is a debate right now whether or not corporations have too much power. So that's why it is, and it's an ongoing debate. And so yeah, that's just one of the active discussions that we currently have in economics. So that's it for the bonus material. I hope you've enjoyed this module, and I'll see you, or you'll hear from me some other time. Thank you.